Okay. Good morning, Swaminathan. Good morning. So, in AS 102 that deals with share-based payments, today we will be quickly running through this particular chapter. Okay. So, when we talk about Ind AS 102, it covers share-based payments of all categories. So, it's not restricted to employees. Any transaction where the consideration needs to be paid in the form of the entity shares or is related to the entity share price, that gets covered under share-based payments. So buying of goods, purchase of machinery, employees rendering services, all of this gets covered under Ind AS 102. Okay. Now, the whole chapter largely focuses on employee share based payments because the variety and the complexities involved in employee share based payments are quite on the higher side. That is why the chapter and the related questions will have a lot of focus on employee share based payments. That given other share based payments also do exist. For your examination, this is one of the key areas that is an examiner's favorite. You do have questions coming on and off in each and every attempt. Okay. So when we talk about share-based payments, without touching into more and more what you say routine areas, we will straight away come to employees share-based payments. Okay. So employee share-based payments essentially means that employee is rendering services to the organization. For the services rendered by the organization, the employer gives the employee the entity's own shares. The entity's own shares. So that is your employee share-based payments. Now, when this comes in, we have a couple of key terms which we will have to just run through. So first one is vest. So when an employee gets the options, when an employee gets the options and he becomes, it is possible for him to exercise those options. That is known as vest. That is known as vest. Vest means to become an entitlement. To become an entitlement. It belongs to the employee and now the employee can encash it and now the employee can take benefit of that option. That is known as vest. Okay. So normally you will have options which start vesting after you have provided certain years of service to the entity. In other cases you will be having certain vesting conditions to be fulfilled. In some cases, you have already rendered some services because of which the employer feels I have to give the options immediately. So that amounts to immediate vesting. Okay. So when we talk about vest means it becomes an entitlement. Then we talk about vesting period. Vesting period means what? Vesting period means the period during which the specified vesting conditions need to be satisfied. Okay. So vesting conditions could be certain service related conditions like you have to be with the organization for 3 years, 4 years. Those are vesting conditions. Okay. Vesting conditions. You need to achieve sales turnover of target of so many rupees. So that is a vesting condition. If you fulfill the vesting conditions, the shares with the options will vest in you. If you don't fulfill the condition, they will not vest in you. You will not become entitled to the options. So these are known as vesting conditions. The period in which you have to fulfill the vesting conditions, that is known as your vesting period. Okay. After the vesting period is over, you come on to something known as your exercise period. Exercise period is typically that period in which the options have already vested. You have become entitled to that option and now you can exercise it. Exercise option means what? You can either tell the company these options are vested in me. So now I want to exercise them. So provide me the shares. Okay. Or provide me the cash payment, which is based on the price of the shares. If it is a stock appreciation, right. If it is a stock appreciation, right. So this is the meaning of exercise period. You fulfill the vesting conditions over the vesting period, and after that, in the exercise period, if you leave, then also you can be entitled to exercise. So an employee who leaves the company will still be entitled to the options if he leaves after the vesting period and he leaves in the exercise period. Then also you can be entitled to the options. Okay. The most important definition is fair value. What do you mean by fair value? Fair value typically means that value which is calculated using an option pricing model, like your binomial model or Black and Scholes model, etc., etc. Okay. Now, for all practical purposes, for your examinations, you will be given the fair value of options. Okay. So in the case of employee stock option plan, where equity shares will vest in the employee, they will be measured at fair value at the grant date. Whereas in the case of stock appreciation rights, you start with fair value at grant date, but you remeasure it every year because that is in the nature of a liability. Okay. So we have seen vesting conditions that you need to fulfill so that the vesting will take place. Vesting conditions could be of two types: service conditions and performance conditions. Service condition just be present in the organization for the specified tenure. Performance condition can be classified into two types: non-market and market condition. Non-market condition, for example, I need to achieve so much of a cost control over the previous year, or I need to ensure that my turnover reaches a specified target, or I need to capture XYZ percentage of market share, or I need to invest so much of capex, or I need to ensure my cash flow from operations is positive to the extent of XYZ. All these are non-market based conditions. These are conditions which are within the control of the entity. So you will be factoring the non-market conditions accordingly. Market conditions, your share price will be XYZ rupees after so many years. That is something which is not in your control. In fact, the market condition will be factored when you're doing the fair value calculation at the grant date. So that is your market condition. It's already factored in the fair value. You do not have to do anything additional about it. Okay. So now, uh, so now with this background, what we shall do is we will try to solve some of the questions where we have all these implications, and in that question solving itself we will move ahead and try to what you can say we will move ahead and try to understand the concepts as we move by. Okay. So far, is it okay, Swaminathan? Any doubt? Yeah, all clear. All right. So let us start by moving to the questions. Okay. 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 I hope this is available. I hope this question is visible to you. Yeah. The following particulars, just see if it's there in the presentation. So we can. Yeah. All right. Fine. Following particulars in respect of stock options granted by an entity are available. Number of employees covered is 400. Number of options per employee is 60. Nominal value per share is rupees 100. Exercise price per share is rupees 125. Shares offered were put in three groups. Group 1, 20% of the shares offered with vesting period of 1 year. Group 1, 20% vesting period 1 year. Group 2, 40% shares vesting period 2 years. Group 3, 40% shares vesting period 3 years. Fair value of option per share on the grant date was 10 rupees for group 1, 12.5 for group 2 and 14 for group 3. In first year, number of employees left is 40. Estimate of employees to leave in year 2 is 36. To leave in year 3 is 34. Employees exercising options in group 1 is 350. Employees who have left is 35 in second year. Estimate of employees to leave in year 330. Employees exercising options in group 2 is 319. Position in the third year, employees left 28. Employees at the end of last vesting period 297. Employees exercising options in group 3 is 295. Options not exercised immediately on vesting were forfeited. Compute expenses to be recognized in each year and show the important accounts in the books of the company. Okay, so we shall proceed to start solving this question. Okay, here what is happening is this becomes something known as what we call graded vesting. Okay, this is what we call as graded vesting. See, normally your vesting comes with a single condition. Okay, that these options will vest in you if you provide services to me for a continuous period of 5 years. Now, today's time, your entities and the employees, there is a pretty fluid kind of a structure. Okay, employees also do not want to I mean, they are flexible to move about and companies have to take that. So what employee will tell is, you are going to give me something after 5 years. After 5 years. Now, that is putting an onus on me to stay with the company. But at the same time, how can you expect me to work with the same rigor for a 5 year continuous period, and you give me something only after 5 years? That does not make sense to me. So what the company will say is, okay, instead of giving you everything at the end of 5 years, we will split the entire plan year wise. So year one, we will give you some options. With a vesting period of 2 years, we will give you some more options. With a vesting period of 3 years, we will give you some more options. Vesting period 4 years, some more. Vesting period 5, we will give you the balance. So the options are spread over the vesting periods of 1, 2, 3, 4, and 5 years respectively. That means this form of vesting ensures that employee is compensated periodically. Suppose an employee leaves after 1 year, he will not leave empty-handed. What are the options which are vested at the end of 1 year, that he will take with him and go. Suppose he leaves at the end of the third year, he will take whatever options are vested in the first plan for 1 year, second plan for 2 years, third plan for 3 years. He will take all these options and go. Fourth and fifth, he will not be taking. So, for whatever tenure he has served, he will get compensated for that. This form of vesting is known as a graded vesting. What is the vesting? This is known as a graded vesting. Okay. So now when we talk about graded vesting, in this particular case, we have three vesting groups. First one at the end of 1 year, second one 2 years, third one 3 years. Okay, so options are given in these three buckets. Now when we have to solve this question, we will be solving as if each plan is an independent plan. So first plan for 1 year, one plan. Second plan for 2 years, another plan. Third plan for 3 years, another plan. So it is like all the sub plans, all the bifurcated plans forming the original ESOP plan, they will be analyzed separate. They will be analyzed separately. Are we okay with this? Yes. Yes or no? So under this category, I am getting 60 options. Okay. Yes or no? So 60 options per employee. Now, it is undertaking three different periods of vesting. Vesting period, 1 year, 2 years, 3 years. So when an employee serves for 1 year, he will take whatever options have vested at the end of year one and resign. He need not wait for 2 and 3 years. At the same time, those who stay for the full 3 years will get plan one, plan two, plan three, all of these getting vested. Okay. Vesting percentage. They have said 20% first year, 40% second, 40% third. Number of options 12, 24, 24. How did I get 60 multiplied by 20%, 12, 60 multiplied by 40%, 24 for plans 2 and 3. Are we okay with this? Yes. Are we okay? Next, fair value. Tell me one thing. Will the fair value be same for all the plans or different for all the plans? Yes. It will be different because the tenure itself is different. So fair value cannot be the same. Fair value also will be different. So they have given 10, 12.5 and 40. 10, 12.5 and 40. Are we okay with this? Yes. All right. Now, when we start to evaluate, that time we will see how to work. So now we move on with plan one. Plan one. Okay. All right. Now, plan one, tenure of the option is only 1 year. Tenure of the option is only 1 year. Okay. So here, number of employees. Number of employees left is 40. Number of employees left is 40. So 40 employees will not get anything. So 400 minus 40, 360 employees. So therefore, options expected to vest is equal to 360 into 12. That is equal to how much? 4,320 options. Are we okay with this? Yes. So total employee benefit expense will be 4,320 multiplied by 10. 4,320 multiplied by 10. Are we okay with this? Yes. Are we okay? So this is going to be your employee benefit expense in respect of the first option. In respect of the first option. So entry that will be passed here. Entry that will be passed here is employee benefit expense account debit to share-based payment reserve 43,200. 43,200. Are we okay with this? Yes. Are we okay? All right. Fine. So now let us move on to plan 2. Plan 2, we will have to do the calculation year wise because this is over 2 years. This is over 2 years. So year 1, tell me, do we do this calculation on the basis of number of employees actually present or on the basis of number of employees expected to be present at the end of the vesting period? How do we calculate? Yeah. How do we calculate? Number of employees expected to be present. So we shall now start pulling up this data. Okay. So out of 400, 40 employees left in year 1. So that is a known factor. That is a known factor. Yes. And in the future, you are expecting 36 employees to leave. So 400 minus 40 minus 36. Number of employees, you can write expected. 400 minus 40 minus 36, 324. End of year 2. Are we okay with this? Therefore, expected to vest 324 into 24. So that gives you how much? 7,776. Total employee benefit is equal to 7,776 options multiplied by fair value per option 12.5. So that gives you 97,200. Are we okay with this? Yes. Are we okay with this? All right. But this is total expense for the 2-year period. Okay. Total. Therefore, employee benefit for year 1, 97,200 into 1 by 2, 48,600. 48,600. Are we okay with this? Yes. Now, is plan 2 over or do we do an analysis for year 2 also? We have to do an analysis for year 2, a similar working. So year 2, number of employees. Tell me now, will I take actual or should I take expected? Now I can take actual, yeah, because the data is fully available. So 400 minus 40 left in year 1, 35 left in year 2, 325. You can see here 35 left in year 2. So this gives you 325. Options vested. 325 into 24. 7,800. All right. Therefore, employee benefit for 2 years. 12.5 less recognized in year 1, 48,600. Are we okay with this? For year 2, my employee benefit expense will be 48,900. Any doubts so far? All right. Okay, perfect. So now we have done this calculation for year 1, year 2. Look at the data here. Can you do same calculation for the third grade, that is whose vesting period is 3 years, Swaminathan? Yes, work it out. I did for year 1. I did for the first category. I did for the second category. I want you to do for the third category. Yes, so do it now immediately. Yeah. Yes. Do it and tell me what is the expenses you are getting for year 1, year 2, year 3 in respect of the third set. Yes. Did you get it, Swami? Year 1, that's right, 32,480. Perfect. Year 2, Year 2, year 2, 99, 120. This is for the whole, okay, perfect, into 2 by 3. This is for the 2-year period. But you have already booked how much in the first year? 32,480. So what will be your perfect? Perfect, perfect. Less year 1, 32,480. So that comes to 33,600. Yes. What about year 3? Yes. Year 3, 99,792 minus what did you book in the first 2 years? Yes. Yes. So that comes to 33,712. Okay. Perfect. So I think I don't need to show the calculations. So now we start off with journal entries. They have asked for accounts. I'll give the journal entries. You can know how to post in the accounts. We will see that and you can understand where this moves towards. Okay, so year 1. Year 1. First entry will be for employee expenses that are being incurred. Employee benefit expenses account debit to share-based payment reserve. What will this be? What will this be? This will be 43,200 of group 1 plus 48,600 of group 2 plus 32,480 of group 3. First, you calculated the last figure, which is right. First two figures we calculated together. 1,24,280. 1,24,280. Are we okay with this? Yes. All right. Next. Can I move to year 2 or is something happening in year 1? Can I straight away move to year 2 or is there something which is happening in year 1? These employees are exercising the options, right? So you will have to take the exercising entry. And also options not exercised immediately were forfeited. So if everybody has not exercised, those who have not exercised, those options you will have to forfeit. Those options you will have to forfeit. So how many employees did I actually have at the end of year one? I actually had 360 employees. Out of 360, they have given that 10 employees did not exercise. Employees exercising options is only 350. Employees exercising options is only 350. So 350 employees we will exercise. 10 employees we will have to forfeit. Okay. So when the options get exercised, what will the employee do? Employee will first pay the money. Bank account debit. How many employees? 350 employees. Each employee gets 12 options. And each option has an exercise price of 125 per share. 5,25,000. Are we okay with this? Are we okay with this? Yes. They have given nominal value of 100. So bank account debit to equity share capital. One second. Four lakh 20,000. Acha. Next. Can I say that employee has also contributed in the form of services render? And because some of the contribution comes from services rendered, that balance is sitting in SBP reserve. Every year you are passing employee benefit expense account debit to SBP reserve, employee expenses account debit to SBP reserve. So that service component is sitting in SBP reserve. We will have to take that out. SBP reserve. For these 320 employees into 12, fair value of this was rupees 10. So that gives you 42,000. Are we okay with this? Yes. And finally, to securities premium. To securities premium. One lakh 47,000. Are we okay with this? Are we okay with this? Any doubts in this entry? Any doubts in this entry? What happened? What is the problem in SBP reserve? Swaminathan, you can unmute yourself and speak, okay? No problem. Reserve has 124, 280. That's right. See, the reserve is having 1,24,280, which is coming from three plans. Plan 1, exercise period is vesting period is 1 year. Plan 2, vesting period is 2 years. Plan 3, vesting period is 3 years. So you still have to carry the SBP reserve pertaining to plans 2 and plan 3, because those exercising will happen in the subsequent year. In year 2, you will exercise some more. That time you need to have balance in SBP reserve. In year 3, you will exercise some more. So you need to still have a balance in SBP reserve. Are you able to follow? Yes. So that 124,280 is not pertaining only to one plan. It is pertaining to three plans. You can see here. Plan 1, Plan 2, Plan 3. Right now only Plan 1 is going out. Correct? But out of plan 1, I have utilized 42,000 only. 43,200 is the balance from plan 1, out of which I have utilized 42. What about remaining 1,200? Total employees you had was 360, 350 exercised. That means 10 would have not exercised. So what is not exercised, I will have to forfeit. So SBP reserve account debit to retained earnings. To retained earnings, 1,200. Now you will ask, how did I get this 1,200? Is there any justification? Yes, total employees you had was 360, out of which 350 exercised the option. Each employee gets 12 options and the fair value of each option is rupees 10. Rupees 10. So 10 into 12, 120 multiplied by 10, 1,200. Are we okay with this? Yes, all right. That means this balance is effectively eliminated. Yes or no? Because it is fully exercised and we have also forfeited what is unexercised. Yes or no? Okay, no issues, Swaminathan. Okay, all right, fine. So year 1 is done. Can we start off with year 2? Year 2. Employee benefit expenses account debit to SBP reserve. How much will come? How much will come here as an expense? This will be year 2, 48,900. 48,900 plus you had calculated for plan 3 as 33,600. 80 to 500. Are you able to understand this? Yes. Are you able to follow this? Are we able to follow? All right, fine. So now there is an exercise which is happening. Employees exercising options is 390. So bank account debit 319 into 24 options into rupees 125. Yes or no? 9,57,000 to equity share capital. Equity share capital. How do we record this? 200. 765, 600. SBP reserve. This is the portion that is compensated through service. 319 into 24 options multiplied by rupees 12.5. Yes or no? To securities premium. 319 into 24 into rupees 37.5. 87 100. Are we okay with this? Yes. All right. Any lapses? Let us check. SBP reserve for plan 2 is standing at 48,600 plus 48,900. 97,500. Out of 97,500, I have debited 95,700. So 1,800 is still left. This has to go. So entry will be SBP reserve account debit to retained earnings. 1,800. How do I validate this? Well, look at the employees exercising 319. Number of employees actually left is 35. That means, see, I started off with 400. Out of 400, 40 left in year 1, 35 left in year 2. So this gives you how much? 325 employees. Out of 325, 6 employees did not exercise because 319 exercise. So 6 multiplied by 24 multiplied by 12.5. 1,800. 1,800. Are we okay? Yeah, perfect. Perfect calculation. Can you try for year 3 now? Can you do same calculation for year 3? Yes. Work out year 3. Work out year 3. Yes. All right. Bank account debit 8,85,000. Correct. First, I hope you have passed employee benefit expenses to SBP reserve because that is the entry for the third plan, third year. Yes. Not 124 280, my friend. It will be 33,712. No. Only third plan, third year. Yes. Yes. This is right, what you have told. Eight lakh 85,000 bank account debit to equity share capital 7 lakh 8,000 to securities premium. Two lakh 76 120. That's right. And finally, forfeiture. How do I see that? You can see it as 32,480 plus 33,600 plus 33,712 minus 99,120 672. Or as you have rightly said, two employees not exercised, 24 options into rupees 14. 672. All clear? Yes, all right. So this is your overall summary question on vesting, exercising, forfeiture. All three aspects we have covered here. All the three aspects we have covered and closed. Are we okay with this? Yes. Now we take fair value at the grant date. Why do we take fair value? Why don't we? So basically, what is happening is this is like a barter transaction. I'm getting services from employee. In return, I'm giving my shares. Okay, so in the barter transaction, normally you will book the income or expense or asset if there is a barter at the fair value of the services received or fair value of asset received, unless fair value of what you are giving up is clearly more evident. So I'm getting a service, giving a share, getting service. If it is more clearly evident, I will take that value. Now employee services, how can it be more clearly evident? I cannot really factor the fair value of services I get, but what I can factor is fair value of shares which I give. The fair value of shares which I give. that can go using an option pricing model. So therefore, fair value of services received, I cannot factor. More clearly evident is fair value of shares issued, which is decided at the grant date. So I will take that particular fair value. Okay, I will take that particular fair value. Number one. Second, why do I not why do I take it at the grant date? Why don't I remeasure? Again, answer is simple. This is my own equity. SBP reserve represents your own equity. Own equity, we never remeasure. Own equity, we never remeasure. We take it to the uh, equity based on the initial recognition value. So initial recognition value is fair value at grant date. That itself will continue throughout the life of the options. Are we okay with this? Are we okay? Any doubts till now? Any doubts? No doubts? Okay, fine. So now let us move to the next one. Again, a question to solve. This doesn't have that question. Okay, fine. Just a second. All right. Yeah. Question 11. Okay. See, now we completed ESOP. Okay. ESOP, we did not do any remeasurement. But in the case of, now we come to the next instrument, that is a stock appreciation right. That is a stock appreciation right. What do you mean by a stock appreciation right? It is basically a payment which will be made to the employee depending on the price fluctuation. So for example, let us consider a case where in an ESOP, what happens? In the previous case we saw exercise price 125. Exercise price is 125. Okay. Now, what was happening in ESOP? Okay. ESOP. What was happening in ESOP? Employee will pay 125 rupees to the company and get the share. Employee will pay 125 rupees to the company and get the share. Okay. Now, coming to stock appreciation right, SARS. Okay. Suppose same thing is there. Exercise price 125. Company says, look, I'm not going to give you equity shares. I will give you a cash payment based on the value of the equity shares. Okay. So that means, let us suppose fair value on exercise date is 300. Let us suppose fair value on exercise date is 300. So what the company will do is, company will make a cash payment to you. Company will make a cash payment of 175 rupees. company will make a cash payment of 175 rupees to the employee. Are we able to follow? Yes. Are we able to follow? Yes or no? This is not fair value. This is, sorry, market price. Market price of the share on exercise date. Okay. Suppose the market price of the share on the exercise date is 300. Company will pay you 175 rupees. Employee will add his 125 rupees and go to the market and buy the share. Are you able to follow? Yes, you are able to follow. This is known as SARS. This is known as SARS. Acha. Suppose he comes to exercise, takes 175 rupees from company. Can he just sit quietly? Of course he can. And that is why SARS gains an advantage over ESOP. In ESOP, the fundamental presumption is employee already has 125 rupees with him. Employee already has 125 rupees with him. So he has to put 125 rupees. Today you will feel what is the big deal in 125. But take this for a big company where you have thousands of options getting vested in you. The payout may run into couple of lakhs or even crores. So that levels of liquidity may not be there with the employee. And therefore, there is an alternative called SARS. In SARS, I may not have 125, but that will not stop me from getting 175. Here kya hoga? What can you say? Okay, you buy a share from 125, trade it in the market for 300, make 175 gain. Correct. But to trade in the market at 300, I need to first own the share by paying 125. That is a limitation. That is a limitation which gets deleted in SARS. In SARS, you basically are exercising to encash the difference. To encash the difference. That difference, if I get directly from my employer, I don't have to pay anywhere 125 rupees. Yes or no? Are you able to follow? Yes. So to that extent, your SARS are more employee friendly. They appear to be more employee friendly. But again, SARS comes with the fact that this is a cash payout that happens. This is a cash payment that employee has to make. And that is why it cannot sit in SBP reserve. It has to become SBP liability. Are we able to follow? Yes. Are you able to follow? It becomes an SBP liability, number one. Second, all liabilities are fair valued at the end of the reporting period. All fair values are uh, revalued at the end of each year. So therefore, your SARS outstanding whatever is there, that gets remeasured at the closing fair value, with the difference being taken to employee benefit expenses. Are we able to understand? Yes, are we able to follow? Okay, fine. So now just go through question number 11. Just go through question number 11. An entity which follows its financial year as per the calendar year grants 1,000 share appreciation rights to each of its 40 management employees as on 1st January 20x5. SARS provide employees with the right to receive, at the date when the rights are exercised, cash equal to appreciation in the entity's share price since the grant date. All the rights vest on 31st December 20x6 and they can be exercised during 20x7 and 20x8. Management estimates that at the grant date, the fair value of each SAR is rupees 11 and it estimates that overall 10% of employees will leave during the 2-year period. The fair value of SARs at each year end are shown below. 10% of employees left before 20x6 end. On 20x7 December, when the intrinsic value of each SAR was rupees 10, 6 employees exercised their options and the remaining 30 exercised their options at the end of 20x8, when the intrinsic value of each SAR was equal to fair value of 12. How much expense and liability is to be recognized at the end of each year? Pass the necessary journal entries. Are we able to follow the question? Yeah. Go through the question once. Give me a minute. Go through the question. Okay. Shall we start? Yes. So now, all the rights vest on 31st December 20x6. I am in 20x5. That means a 2-year period. Okay. X5 and X6. Okay. Now, when it gave the grant, when it granted the SARS at the grant date, the fair value of each SAR is rupees 11. Okay. Is this relevant for us, or is this more relevant? Is 11 relevant, or is 12 more relevant to us? Clearly, 12 becomes relevant because I remeasure the SAR at each reporting date. I remeasure the SAR at each reporting date. 11 would have been relevant if the SARs vest immediately on granting. If the SARs were to vest immediately on granting, not over a 2-year period, if they are to vest immediately, then 11 would have been relevant. Right now, 11 is not relevant because even though I book at 11, I will have to restate it at 12. So therefore, I will do my working with 12 itself. Okay. So for year one, my expense. Okay, I will do one thing. I will write it in the question 11. Okay. Question 11. Year 1. Two zero x5. What is the expense? What is the liability? Working. Okay. How many employees I have? 40. Somewhere they have given 10% overall will leave. So therefore, 40 minus 4 multiplied by 1000 share appreciation rights multiplied by fair value 12. This is for the full life, but I'm doing it for the first year. 2,16,000. Expense also will be 2,16,000. Are we okay with this? Yes. Are we okay with this? Because of 2 years, no? See, 1st January 20x5 to 31st December 20x6. You can see here all the rights vest on 31st December x6. When did you give it? 1st January x5. So vesting period is 2 years. Okay. Vesting period is 2 years. Yeah. All right. Fine. So this is your first year. Employee benefit expense account debit to share based payment liability. SBP liability 2,16,000. Next. Next year. Again. 10% of employees actually left before 20x6. So 36 into 1000 SARS into rupees 8 into 2 by 2 full. So 2,88,000 will be your closing liability minus 2,72,000 will be your employee benefit expense. Are we okay with this? Yes. Yes or no? Year one, because we do it based on estimate, no? So 40 management personnel estimates that overall 10% of the employees will leave during the 2 year period. So 40 minus 10% of 40 will be 4, so 36. And luckily what you estimated also became actual. What you estimated also became actual. All right. All right. Fine. 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 Perfect. So 2,88,000 will be your closing liability. So expense for 20x6 will be 72,000. Okay. Then 31st December 20x7. What is happening here? On 31st December, when intrinsic value of each SAR was rupees 10, 6 employees exercised their options. 6 employees exercised their options. Out of 36, 6 have exercised. That means 30 will still remain in balance. And what have they said? Look at the exercise period. They can be exercised during 20x7 and 20x8. That means if nothing is exercised by 20x7, can I reverse the open positions? Answer is no, because you have to wait till 20x8. So 20x7, 20x8, you can exercise the options. You can exercise the options. In the first year, 6 employees exercise. That means closing will be for 30 employees. So closing will be 36 minus 6 multiplied by, yes or no? Multiplied by 1000 SARs. Yes. And what is the fair value? 13 rupees 30. Are we okay with this? 3,90,000. Are you okay? Yes. Liability will continue until December 20 exit. That's right. Yes. So 3,90,000, if this should be your liability, in respect of this, how much will you book? 1,02,000. 1,02,000. Are we able to follow? Are we able to follow? Three lakh 90 minus 1,88,000. Yes, 3,90,000 minus 1,88,000. Yes, did you follow? 1,02,000. Yes, all right. Now, one part is pending. See, 6 employees have exercised the option, yes or no? 6 employees have exercised the SAR. They have exercised it when the value of each SAR was rupees 10. When the value of each stock appreciation right was rupees 10. That means 6 employees into 1,000 SARs into rupees 10. This gives you how much? 60,000. Yes or no? Yes or no? Correct? This gives you 60,000. Now, can I say that this 60,000 will come in as an expense? Can I say that this 60,000 will come in as an expense? Why? Because see, this expense of 1 lakh 2 is only in respect of 30 employees. Only in respect of 30 employees, excluding the 6 who have already exercised. Yes. So these 6 employees are already exercising the options and taking away this. So therefore, I will have 6 into 1,000 SARs into rupees 10 as my further expense. Are you able to follow? Yes, it is in respect of those SARs which they have exercised and taken this money. Which they have exercised and taken this money. Are we able to understand this? Yes. Are we able to follow? All right, fine. And in the next year, 31/12/20 x 8. What is it saying? The remaining 30 employees exercise options when the fair value, intrinsic value equals rupees 12. So here there won't be any closing liability. There won't be any closing liability. Why? Because it is extinguished. Because it is extinguished. Now, 30 employees are exercising the option at 12 rupees. 30 employees are exercising at 12 rupees. Yes, 3,60,000. Yes, can you agree to this? 3,60,000. Yeah, you got it. Now, my closing liability is how much? 3,90,000. I will be paying only 3,60,000 because this is the fair value on the settlement date. So I will be having a net negative employee benefit expense of 30,000. Did you follow? This is nothing but 3,60,000 settlement value minus 3,90,000. Are we able to follow? Yes, because after paying 3,60,000, you cannot keep yes, we need to credit the P&L with 30,000 rupees. We need to credit the P&L with 30,000 rupees. Are we able to follow? Yes, everybody, Swaminathan, able to follow. Okay, so that takes care of stock appreciation, right? That takes care of stars. Okay. So, do you need a break now or shall we take a break later? We take a break now? Yeah, it's 8:30. We take a break now. We shall resume at 8:45. It's almost 8:30. So, take a 15-minute break and then we shall look into another set of questions before we wind up. Okay. So, break, please. Okay, fine. Yeah. So we completed evaluating employee stock options as well as stock appreciation rights. Okay. So now uh, this was just some questions which we have already started to discuss. Okay. So I think we covered question number 5 already. Okay. That was the biggest one. And we also covered question 3. Okay. All right. Fine. Now, let us move on to this particular question. Small question. Entity A runs a copper mining business with year ending 31st March. Dividends declared on the shares accrue to the employees during the 3-year period. If the condition is met, the employees will receive the shares together with the dividends that have been declared on those shares during the 3 years up to March X3. Entity estimated that on 1st April 20X0, its shares are valued at rupees 10 each. The grant date fair amount of each share is rupees 10. Entity A prepares annual financial statements for the year ended 31st March, and on 1st April, it estimates that 800 shares will vest. That means at the beginning of the year. At the end of the first year, it has revised the estimate to 780. At the end of second year, 31st March X2 revised it to 750. 750 will vest on 750 shares have vested on 31st March X3 based on the number of employees still employed on that date. On 1st April 20X0, as part of a long-term incentive scheme, Entity A provisionally awards its sales employees 1000 Entity A's shares receivable on 31st March 20X3. Explain the accounting treatment for the above share-based awards based on satisfaction of condition that the sales employee must remain in employment till 31st March 20X3. The requirement to remain in employment is a service condition and would not be reflected in the fair value of the share awards, which is obvious. Only market conditions will be reflected in the fair value. Service conditions, we do an estimation at the end of each reporting period. Yes or no? All right. So with that background, it's a very simple question. So what is your fair value? 10. Tell me one thing. How many shares are expected to vest? Will you take at the beginning of the reporting period or at the end of the reporting period? Which becomes critical? At the end. Your mic was working, no, Swaminathan? What happened? 780. Okay. So at the end of year 1, this becomes relevant. End of year 2, this becomes relevant. Year 3, anyways, actual will vest. Okay. So first, Manish ji, can you just see he's unable to unmute?
Okay, sir.
Yeah, Swaminathan, done. So are you able to follow? I think you can unmute yourself for the session. It's just the two of us who are there. Okay. All right. Fine. So can you tell now 780 becomes relevant, right? Yes, Swaminathan, go ahead.
Okay, sir. Unable to unmute. That's what. Now it's okay, sir.
Now it's okay. All right. Fine. So 780 employees, 780 shares expected to vest. This will be my number for the first year. 780 multiplied by 10 fair value on the grant date multiplied by 1 by 3. Vesting period is 3 years, no? Yes, during the 3-year period. Here also they have given. Remain in employment until 31st March 20X3. So 780 into 10, 7,800 into 1 by 3. This gives you 2,600 for the first year. Are you okay with this? Yes? Yes or no? Correct. Year 2, 750 employee, I mean 750 shares into 10 fair value per share into 2 by 3. This comes to how much? 5,000. I don't know what is the problem.
Okay, sir. Now
Okay.
it's so.
Now it's
Yeah.
okay. 5,000 minus what was recognized earlier, 2,600. So year 2 will be 2,400. Okay. Plain simple calculations. This is not as complex as what we have done today. That is why I'm going a little fast. Okay. Year 3, 750 actually vested into 10 into 3 by 3, 7,500 minus till year 1 and year 2, 5,000. So 2,500 in year 3. These are the expenses. Are you able to follow? 1, 2, 3. Any doubts here? All clear? Okay, perfect. So 2,600, 2,400, 2,500. These are your workings. Okay. So that takes care of question 6. ठीक है. Next. Okay. Now, two small questions, theoretical largely. Okay. New age technology has entered into the following share-based payment transactions. On 1st April, New Age Technology decided to grant share options to its employees. 1st April decided to grant. The scheme was approved by the employees on 30th June 20x1. New Age Technology determined the fair value to be the value of the equity shares on 1st April 20x1. Identify the grant date and measurement date supported by appropriate rationale. So tell me, first case, what is the grant date and what should be the measurement date? Come on. 1st April grant was given, 30th April approved by employees. Fair value at the grant date, they are saying we will take 1st April value. You tell me. Go on. Yes.
Okay, sir. Here the thing is that whenever I raise hand, that time only they will unmute. Then only I can be able to speak it. Once
Okay.
I once I know, it will go for unmuted mode immediately.
Oh, okay. I didn't know that. Okay.
Yeah,
Okay.
that is the reason I could not answer to your
You could
questions.
not answer. Okay. Now you are there online. So tell me.
Yes, sir. Sir, in this case, on the first case, the grant date will be 30th June, sir, and measurement date also 30th June.
Okay. Okay. Okay.
The
Okay.
reason is that that date only the employee is approved.
Okay. Okay.
That's the reason for that.
Employee has approved. So measurement date will be 30th June. And you are saying that grant date also will be 30th June. Okay. The date. So what is the grant date in terms of the standard? The date at which the entity and another party agree to a share-based payment arrangement, being when the entity and the counterparty have a shared understanding of the terms and conditions of the arrangement. Grant date occurs only on agreement, which could be explicit or implicit. So offer by the entity and acceptance by the counterparty. If that agreement is subject to an approval process, grant date will be the date when the approval is obtained. So in this case,
Yeah, it is approved on 30th June only.
yes. 30th June approved by the employees. So grant date 30th June, measurement date 30th June, both will be the same. Okay, all right. Next, on 1st April, New Age Technology entered into a contract to purchase IT equipment from Bombay Software Limited and agreed that the contract will be settled by issuing equity instruments of New Age Technology Limited. New Age Technology received the IT equipment on 30th July. The share-based payment transaction was measured based on the fair value of equity instruments as on 1st April 20XY. Tell me, what is the grant date? What will be the measurement date?
Yes, sir. In this case, the material received on only 30th July. The
Correct.
measurement will always begin when the material is received.
Yes.
And as far as the grant date, they agreed the terms and condition everything on the 1st April itself here.
Correct.
So
Correct.
we can provide the grant date as the 1st April.
So grant date 1st April, measurement date 30th July. Perfect. Next, on 1st April, the company decided to grant options to its employees. Scheme was approved by employees on 30th June. Issue of share options was subject to approval of shareholders. Scheme was approved in the general meeting held on 30th September. Fair value was taken on 30th September. So what will be the grant date and measurement date here?
Here the shareholder also is approved, which
Yes.
means the measurement will begin from 30th September
And
only.
grant
The
date?
grant date also they approved only the 30th September only.
Correct.
So
Absolutely. So grant date 30th September, measurement date 30th September, basis all done. So that resolves this question, question number 4. Okay, so 3, 4, 5, 6 we did, question 7. Simple question. Okay. Fashion India Limited entered into an agreement with RFD on 10th August for purchasing a machinery. The agreement has a clause that FIL will have to settle the consideration by issuing its equity shares. So it becomes a share-based payment transaction. FIL agreed to the clause and the order was confirmed. Machinery was supplied via invoice dated 25th October, delivered on 1st November 20x2. Agreed purchase consideration was 150 lakhs. Fair value of the machinery supplied was estimated to be 160 lakhs. As agreed, FIL issued 1 lakh equity shares of face value 100 each to RFD Limited. As per Ind AS 102, what should be the price and the date for recording the machinery purchased from RFD Limited? Yes. What do you think? Price and date. When will I record?
so we will record on the delivery date only, on the date when
Correct,
material is
because that
received.
is the date you are actually getting the machinery.
Here the
So,
first November will be the we received.
correct. And you will measure it at what value?
Value we agreed to issue 1 lakh share, right? 1 lakh share into
That is
100
the
each.
consideration we are giving. We will issue
Okay.
1 lakh. So, you are saying you will measure at 1 lakh into 100.
1 lakh in
100
100,
lakhs.
which means 100 lakhs only will there. But we agreed on 160 lakhs, right?
Correct. The fair value of the machine supplied is 160 lakhs.
Yeah, then it will be the premium
Yeah,
actually.
so 60 lakhs will be the premium. Your value of the machinery will be 160 lakhs. Agreed purchase consideration is irrelevant because agreed PC, you can agree anything. But what is the fair value of what you are getting? The fair value of what you are getting is 160 lakhs. So therefore, 160 lakhs will be the purchase value of the machinery. 100 lakhs will go to capital, 60 lakhs will go to premium. Are we okay?
Yes, sir. Since India is involved in the fair value measurement, we got to use the
Yes.
fair value.
Yes, yes, yes. So that completes a little bit of discussion on these areas. Okay, all right. Now today we started off with employee share based payments, that is ESOPs, and then we moved on to stock appreciation rights, correct? So the first option gave, the first case employee was getting shares. The second case employee was getting cash. Now there is a combo instrument. There is a combination instrument. He can get shares also, he can get cash also, depending on his choice. This is share-based payments, equity settled payments with a cash alternative. Equity settled payments with a cash alternative. So employee is having an instrument which gives him the right to exercise and get equity shares. But the same instrument also gives him the option to say that, no, I don't want equity, I want cash. Are you able to follow? Yes.
Yes, sir.
So it is a combo offer. It is a combined offer. Now, tell me one thing. An option which gives only equity shares, number one. An option which gives only cash, number two. An option which gives a choice between equity or cash. Which is most valuable out of these three things? Case,
Cash, yeah, cash is most valuable, sir.
case one, only equity. Case two, only cash. Case three, choice, equity or cash with the holder. Which, according to you, becomes more valuable?
Cash is
More,
most.
no, it will be this. It will be the third one. Third one will become valuable. Why? Because this is giving the best of both the things. This is giving the best of both the things, right? And therefore, your third category will become more valuable. Is it okay?
Yes, sir. According to the benefit, the employee can choose it.
Yes, they have a choice to choose. They want equity, they can take equity shares. They want cash, they can take cash. That flexibility makes this instrument more valuable than the first two. Okay.
Yes, yes, sir.
Now,
I thought that when the share price is no, like he can get the cash and he can buy in the outside market. That's why.
absolutely. Yes.
Okay, sir. Fine.
Yes, yes, yes. So now, so now, uh, the issue with this instrument, you tell me, should I account for it as an equity? Forget the question. Don't look at the question. This instrument, should I account for it as a liability or should I account for it as an equity? What do you think?
So it is a hybrid nature. Both has to be recognized.
Both has to be accounted, but principally, what are you going to account it as? A liability or as an equity?
It's a liability.
Principally, you have to show it as a liability because there is a cash component involved. Tomorrow, the employee can wake up and demand cash, in which case the entity has to make the cash payout. So therefore, in this scenario, you will book as if it is a liability. You will book as if it is a liability. Are we able to follow?
Yes, sir.
Yes, all right. So now let us move on to the question. Let us move on to the question. Okay. All right. This is a share-based payment arrangement with a cash alternative. Okay. On 1st January, ABC gives options to its KMP to take either a cash equivalent to 1000 shares or 1500 shares. Okay. So two options. Cash equivalent of 1000 shares or 1500 shares. The minimum service requirement is 2 years. This is your vesting condition. and shares taken must be kept for 3 years. This is restrictive condition. Restrictive condition. If you take the shares, you will hold it with for a period of 3 years at least. Okay. Fair value of the shares are as follows. Share alternative fair value, that is with restrictions, 102. Grant date fair value, 113. Fair value on 31st December 120 X1 and end of year 2 it is 132. The employees exercise their cash option at the end of 20X2. Pass the journal entries. Okay. What am I having? I am having an option given to my employees. That option has two choices that were given to the employees. Either you take 1,500 shares, number one, or you take cash that is equivalent to 1,000 shares. So employee has two options. Okay. So now, first thing, 1,500 shares. Can I say this is equity alternative? Can I say this is my equity alternative?
Yes, sir.
So value of equity alternative on the grant date. Grant date fair value is 102. Correct?
Yes, sir.
Share alternative fair value is 102. You have to hold these shares for 3 years. So it comes with restrictions. So equity alternative 1,500 into 102, 1,53,000. Is it okay?
Yes, sir. First, initially, we have to evaluate fair value.
Yes, this is the first component that we are measuring. 1,53,000 is the fair value on the grant date. The next instrument is 1,000 shares cash equivalent of that. So grant date fair value on 1st January is 113. And this is how many shares? 1,000. Yes or no?
Yes, sir.
Correct. So 113,000 will be the value of your cash alternative on the grant date. Cash alternative on the grant date. So now employee has two options. Employee has two options. He can either accept a cash settlement of 1,13,000 or he can say don't give me cash, instead give me equity shares of 1,53,000. Are you able to follow?
Yes, sir.
That means effectively the equity option value is 1,53,000 minus 1,13,000. That is 40,000 will be the equity option value. Correct?
Okay, that is a extra. If the
Extra.
employee is chosen the equity option, then a company has to pay extra 40,000.
Yes, because you are getting something more valuable by 40,000 rupees. Yes.
Yes, sir.
In the first case, employee gets 1,13,000 on grant date and he's out. In the second case, he's getting shares worth 1,53,000 rupees. So that something extra is valued at 40,000 rupees. Correct?
Yes, sir.
Yes. So now there are two components here. First component is the equity option. Equity option, whose value is 40,000 over 2 years. So 20,000 and cumulative they are saying. So it will be 20,000 in the first year and 40,000 in the second year. Are you okay with this?
Yes, sir.
Yes, pretty clear, right? Next, you have a cash alternative. Now, the cash alternative, should I remeasure at each reporting date?
Yes, sir. We need to remeasure.
Obviously, absolutely right. So, December 20X1, the value is 120. So 1,000 shares into 120 into 1 by 2. That gives you 60,000. Correct? Yes.
Yes, sir.
Why 1 by 2? Because service requirement is 2 years. Service requirement is 2 years. Correct?
Yes.
So 1,000 into 120 into 1 by 2, 60,000 will be the expense pertaining to the cash component. Correct?
Right, sir.
So your total expense will be 20,000 equity option, 60,000 cash option. Total employee benefit expense will be 80,000 rupees. Correct?
Yes, sir. Perfect.
This is for year one. Year two, again, equity option expense will be 20,000 only. We do not have to remeasure anything. Liability component, 1,000 shares into the fair value is 132 into 2 by 2. So that gives you 1,32,000. Out of this, 60,000 already recognized. So you will be left with 72,000. Are you able to follow? Yes.
Yes, sir.
Any doubts?
No, sir. It's very clear.
So for the second year, my expense will be 20,000 equity component and 72,000 cash component. So total expense will be 92,000 rupees. So entry will be employee benefit expense account debit 80,000 to SBP reserve 20 to SBP liability 60. Second year, same thing, employee benefit expense account debit 92,000 to SBP reserve 20 to SBP liability 72,000. Are we okay with this?
Yes, sir.
Then employees exercise the cash option at end of 20x2. How much cash will be paid? 1,000 into
132.
132. 1,32,000. That means SBP liability debit to cash bank.
Okay.
There is some disturbance. Yeah. SBP liability account debit to cash bank 1,32,000. Correct?
Yes, sir.
All right. And I cannot keep SBP reserve now. He went for cash, means he did not go for equity. So therefore, SBP reserve will be transferred to retained earnings. It shall remain within equity and we are moving it within the instruments. Are you able to follow?
Yes, sir.
Yes, clear? This question is clear. Any doubts?
Sir, why we finally moving to retained earnings, sir?
See, the plan is over. No, when he exercised the equity, when he exercised the cash alternative, options are over. Now he cannot come back to the company saying, I have equity option available. No, you chose cash means you gave up equity. You will not get both. You will get either cash or you will get equity. You chose cash means you will not get equity. If I will not get equity, how can I keep SBP reserve in my books? Yes or no?
Okay,
Right?
liability, the reserve we are liquidating now.
Reserve we are eliminating. Reserve we are eliminating. We created the reserve, no, 20, 20, 40,000.
Yes, sir.
That reserve we are transferring it to retained earnings. So at the end of year two, your financial statements will not show SBP liability also, will not show SBP reserve also, which is a correct presentation. Okay.
Right, sir.
All right. What I want you to do is, I want you to start working out question 2. Same lines, nothing different. Okay, start working out question 2. Tata Industries issued share-based options to one of its key managerial personnel, which can be exercised either in cash or in equity. And it has the following features. Okay. So what are the features? Number of cash settled shares 74,000. Service condition 3 years. Number of equity settled shares of face value 100 each 90,000. Service period 3 years. Restriction to sell is 2 years. Equity price with a restriction 115. Fair value at grant date 135. Fair value at the end of each of these periods is given. Pass the journal entries. Okay. So at this stage, I think you can proceed to take the calculations. Yes, you can start and calculating, Swami. Yes, start calculating. Yeah. I'll just be back in a minute. You do the calculation. Okay, you could do on similar lines. Yeah. Okay. So equity option 74,000 shares multiplied by 115. Sorry, not 74. Number of equity settled shares is 90,000. Multiplied by 115. 1 crore 3 lakh 50,000. Cash option on the grant date 74,000 into 135. 99 lakh 90,000. Difference between these two 3 lakh 60,000 equity component. 3 lakh 60,000. This will be your equity component. 3 lakh 60, you will evenly spread it over 3 years. 3 lakh 60 divided by 3, 120, 120, 1 lakh 20,000. So you will evenly spread it out over 3 years. Is it okay? Yeah. And as
Yes, sir.
far as
Yes, sir.
yes, Swaminathan, tell me.
Yeah, yes, sir. So actually, my connectivity issue, I rejoined now.
Okay. So 3,60,000 divided by 3, 120, 120, 120 each year we will recognize. Cash option, we will remeasure at each reporting date. We will remeasure at each reporting date. So I have 138, 140 and 147. So if I have to work it out, first case, 74,000 is the number of cash settled shares, that is SARS. Into end of first year value is 138. So 74,000 into 138 divided by 3, because vesting period is 3 years. Service condition is 3. So 34 lakh 4,000. So employee benefit expense 35 lakh 24. To SBP reserve 1 lakh 20. To SBP liability 34 lakh 4,000. Is the first entry clear?
Yes, sir. Clear, sir.
Yes. Second entry, employee benefit expense account debit to SBP reserve 1 lakh 20. To SBP liability, this will be 140 multiplied by 74,000. This is for the full tenure. So into 2 by 3 minus what I have recognized earlier. So 34 lakh 4,000. 34 lakh 4,000 I will subtract. This was recognized earlier. So 35 lakh 2,667. Year 2 is okay.
Yes, sir.
All right. Fine. 35 lakh 2,667. Year 3. Year 3, the value is 147. So 147 into 74,000 minus total of the expenses we have booked in the first 2 years. 34 lakh 4,000 plus 3502 667. Able to follow? Yes.
Yes, sir.
And 1 lakh 20 equity as it is. So this is your year 3. Okay. Now, if you choose the cash alternative, you will get the money. So SBP liability debit 147 to cash bank 1 crore 8 lakh 78,000. SBP liability goes away. Yes, that is this plus this plus this. Total is 1 crore 8 lakh 78,000. So this is paid off. This is paid off. Next, SBP reserve, we will move it to retained earnings because now plan is not there. I cannot keep SBP reserve. Are you okay with this?
Yes, sir. This is exactly as the previous question.
As the previous question, exactly as per the previous question. Okay.
Yes,
Next,
sir.
if
In,
you choose equity shares, SBP liability will go away 1 crore 8 lakh 78,000 because now instead of liability you will get equity shares. Correct? You will get equity shares. Yes or no?
yes, sir.
So SBP liability 1 crore 8 lakh 78,000 to share capital 90 lakhs. How did I get 90 lakhs? 90,000 multiplied by
That
of face
115,
value 100 each.
100.
Yeah. So 90,000 into 100. And securities premium is the balancing figure 18 lakh 78,000. SBP reserve I cannot keep, but this I will not transfer to retained earnings. I will move it to
Profit and loss.
securities,
Yeah, okay.
securities premium. Right? Why securities premium? Because in this case, you are going to get uh, equity shares. So you are effectively issuing shares at a premium. So it is going to be part of the equity settlement that is happening. So you will take it to securities premium. Is it okay?
Get that balancing figure.
Which one? This one, right?
Yeah, that's 1 crore 8 lakh 78,000 minus 90,000.
This is a balancing figure. Yes.
That we are going to straight away moving to the securities premium.
This will move to securities premium, but
Okay.
we also have SBP reserve balance, no? Yes or no?
Okay, already the 1 lakh 20, 1 lakh 20, 1 lakh
We
20.
were accruing now 120, 120,
Okay,
120.
okay.
That also I will not move to retained earnings. I will move to securities premium. Okay.
Okay, since it is relating to the equity.
Yes, since I have exercised equity option, all of this will be moved to equity. I mean securities premium.
Oh,
Okay.
okay, okay, sir.
If cash option was exercised, I moved it to retained earnings. I cannot have premium. But here equity option is exercised, so I am moving it to securities premium. Is it okay?
Yes, sir. In the financial instrument, we
Yeah,
call it as a compound financial. This is a
correct.
compound.
This is a compound financial instrument.
Then there will the split account will happen.
Split is already done here.
Yeah, yeah. Here already done. In there,
Yes,
it is split done accordingly. They will identify the balancing figure as a equity portion.
yes, yes. So here also we have taken balancing figure as equity. 3 lakh 60 is a balancing figure.
Yes, sir. Yeah, I could recognize. There also we will move to equity securities premium only.
Yes,
Cash,
yes, yes.
yeah, fine, sir. Cash always go to retained earning.
Correct. Because I haven't issued securities, so I cannot have securities premium if I exercise cash alternative.
Yes, sir. I could see the similarity between the standards.
Okay, fine. So that at least whatever questions we had lined up for today, we could kind of finish everything. There is nothing which is pending on this front. Okay. Now we shall quickly run through the presentation just so that we are okay with what all has been covered or what all is being covered. Okay. Just a second. Most of it you were already there in the discussion, so I don't have to add anything. Okay, this is okay. All right. So grant date, all this is okay. Next. Equity settled, we have seen. Practical difficulties, we cannot measure the services received by the employees. So we measure it by reference to fair value of equity instruments granted. This is why we use the fair value on the grant date. Okay. All right. Next. Uh, Transactions with employees and others providing similar services, reference to fair value of equity instruments granted. Fair value of goods or services received, if they can be measured reliably, you take that as the measurement principle. We saw that in the case of that machinery example where we took 160 lakhs as the value. That was measurable reliably. So we took that as the value. Yes or no?
Yes, sir.
Yeah. So that was your uh, parties other than employees where you can go for that. Recognition of services. Vesting immediately, it shall be presumed that service are rendered and you will take the full hit immediately. Do not vest until the service is provided. We spread it gradually over 3 years or 5 years. We saw the example. Okay. If employees is granted share options based on vesting conditions, effect of service condition, entity shall presume that service to be rendered by the employee as consideration will be received in the future over the 3-year vesting period. So you will presume that over the next 3 years, he will provide the services. Effect of a performance condition, achievement of performance condition and remaining in employment until the condition is satisfied. The length of the vesting period varies. So you shall presume that the services to be rendered will be received over the expected vesting period. I will estimate the vesting in the case of market performance condition In the case of non-market based performance condition, depending on when I expect the conditions to be fulfilled. Estimate the length of the vesting period based on the most likely outcome of the performance condition. So if they say you have to achieve your target in so many years, or they will give some kind of a number that by the next 5 years we should have 32% market share, or we should have a revenue of say 1000 crore or 500 crore, whatever it is. So your job is to meet that number at the end of 5 years. Okay. So if that is the case, uh, meeting the performance condition over the 5 year period will be the basis for spreading your employee benefit expenses. You will be spreading it over the 5 year period. Is it okay?
Yes, sir.
Yes.
Yes, sir.
All right. So much of it we have covered. If performance condition is a market condition, non-market condition, every year you will revise depending on the estimate of the vesting period. You will revise it every year. Whereas a market condition, if it is there, it is already forming part of the fair value. It is already put in the fair value calculation. So you shall not do any subsequent revision. Are we okay with this? Yes.
Yes, sir.
All right. How will I determine the fair value? If market prices are available, consider the market prices. If market prices are not available, then you will have to use a valuation technique. Okay, so straightforward. Conditions having an impact on fair value of equity instruments granted. These are vesting conditions being market conditions and all non-vesting conditions. Number of conditions having an impact on number of equity instruments expected to vest will be the vesting conditions, not being the market condition. Are you able to follow?
Yes,
Yes.
sir. Yes, sir.
Your market based conditions, like my market price will be so much, or my PE multiple will be so much, enterprise value EBITDA multiple will be so much. All these are something not in your control. They will be factored in the fair value calculation. Any non-vesting condition will be factored in fair value calculation. But in your fair value working, number of equity instruments, you will have vesting conditions which are non-market conditions. 3 years tenure, 2 years tenure, all of that. Okay, so that takes care of equity and non-vesting conditions in determining fair value of equity instruments. Okay. Adjustment to equity, whatever balance is left after the plan expires or everybody has exercised, we shall move it to share-based payment reserve. This shall move into share-based payment reserve. Are we able to follow?
Yes,
Yeah,
sir.
this is what we have been doing. Okay. All right. Fine. Okay, I think this one question we did. Okay. Okay. Anything specifically troubling you, Swaminathan, in this particular chapter, then I can cover that. Otherwise, I will have to go in a serial order.
No, sir. You can go as per your plan, sir. No problem.
Do you have anything else to discuss apart from what we have covered already for the revision?
No, sir.
Okay, fine. So modifications to the terms and conditions of the plan. Sometimes when you do the modification could result in modifications which benefit the employees, modifications which do not benefit the employees. Modifications which do not benefit the employees, please do not give any effect of that. Please do not give any effect of that. Why? because the point is it is an option which is given to the employees. If they find that an option is not beneficial, they will only not exercise. So you do not have to do anything. But if we talk about modifications which are beneficial to the employees, you will do a prospective accounting. You will do a prospective accounting. What do you mean by a prospective accounting? Prospective accounting means the modification effect will be given from the date of modification itself. You will not go back in time and do a restatement. Are we able to follow? Yes.
Yes, sir. Modification will be treated as estimate, not accounting
Uh,
policy.
Not estimate, but you will give a prospective accounting. So in that sense, yeah. If you say that it will be taken in that manner, then yes. Okay.
Okay.
Yeah.
For keeping in memory, that's what I am
I know, I
thinking.
know.
Like,
For keeping it in memory, you treat it as an estimate, but technically it is not an estimate. You are modifying the terms of the plan itself. Okay.
yes, sir. Yes, sir.
But it is fine. You have to do the accounting normally. You have to do the accounting normally, prospectively. Okay.
Okay, sir.
All right. Fine. Next. Cancellation of a grant. Cancellation of grant means what? Suppose you have given an option whose vesting period is 3 years. At the end of the second year, you will not, you know that you will not fulfill the grant requirements. Okay, you don't want to get into the grant, you want to come out of the grant. So at the end of year two, you go to the employees and say, look, I had an ESOP that was to vest after 3 years, but now I don't want it to vest in you. Okay, now we will handle it. So therefore you were having certain uh, uh, grant which is now taken away from employees. Do you think employees will sit quietly if the grant is taken away from them?
No, sir. They will give the reaction. Whether
No.
they will.
So that is what. So exactly what will happen is for whatever you have taken back, you will have to give them in the form of some compensation. You will have to give them in the form of some compensation. Yes or no?
Yes, sir.
Yes. So when we talk about cancellation or modification, it is known as accelerated vesting. It is known as accelerated vesting. Why do we call it as accelerated vesting? We call it as accelerated vesting because whatever balance, expense and all need to be recognized, you recognize and finish it off over the remainder of the vesting period. Is it okay? Yes.
Yes, sir.
Why do I do this? Because I anyways have to pay them the compensation, number one. Second, uh, as part of the, I have to pay them. And secondly, as part of the cancellation of the scheme, whatever is there, I cannot write it back. I will have to expense it off. I will have to expense it off. Are we okay with this?
Yes, sir.
Yes. All right, fine. So we have this small question that is there as part of your modifications. Okay. Marathon Inc. issued 150 share options to each of its 1,000 employees subject to the service condition of 3 years. Fair value of the option given was calculated at 129. Below are the details and activities related to the SBP plan. 35 employees left and further 60 employees expected to leave. Share options repriced as the fair value fell to 50. After repricing, they are now worth 80 rupees. Hence, expense is expected to increase by rupees 30. Year 2, 30 employees left and further 36 employees expected to leave. Year 3, 39 left. How the modification or repricing will be accounted? Is it okay? Yes.
Yes, sir.
Question understood?
Yes, sir.
All right. Now, see, first one, let us calculate the original option. Original option has a fair value of 129. Yes. And how many people? 1000 people, out of which fair value of option was calculated at 129. Okay. Year one, 35 employees left, 60 expected to leave. Year two, 65 left, 36 expected to leave, 104 left in year three, 0 left to this thing. Okay. So therefore, the total number of employees at the end of year is 905, 899, 896. Till now, is it okay?
Yes, sir.
Yes. Now, after okay, so original plan, 905 employees multiplied by 150 shares per employee multiplied by 129 fair value. 129 fair value. Yes.
Yes, sir.
Right. Into 129 per share into 2 by 3, and for the third year 3 by 3 less expenses. Okay, so that takes care of year 1, 2 and 3. This till here it is pretty straightforward. Any doubts here?
No, sir. This is very straightforward till now.
Okay, next you are having a modification in year 2 and year 3. This modification in year 2 and year 3 is basically arising because of the repricing of the options. So now it is there for 30 rupees. So now I have how many employees? 899 employees multiplied by 150 multiplied by 30. This is incremental. This is incremental into 1 by 2. 20 lakh to 22,750. Are you able to follow?
Sir, here, what it means, sir? Why the 30 rupees in addition to 129 rupees we are going to pay?
Yes. Because what is happening is, see, let us consider a case where I have given an option. See, I gave an option, let us suppose, when the market price of the share is 100. Hypothetically, forget this example. I gave an option when the market price of share is 100. I gave exercise price of 75. And fair value is, let us suppose, 50. You understood this? Okay.
Yes, sir.
This was the initial option which I gave. Market price is 100, exercise price is 75, fair value is 50. Now, let us suppose after some years, when the vesting period is still ongoing, the market price of the share falls to 65 rupees. What will be the fair value of the option now? Apply common sense and tell me what will be the fair value of the option. You don't need calculation. If you don't reprice this option, your option is junk. It's just a piece of paper. Yes,
Yes, sir.
because employee will never exercise the option.
Because the market price itself is very low.
Yes, since market price is very low, your fair value will be zero. They will not exercise it only, correct? So now suppose he reprices the option. That means what? He will say, okay, price has fallen. So now exercise price will be 30. exercise price will be not 30. Let us do one thing. Let us make it more attractive. Let us say exercise price is 10. Now it becomes all the more attractive for the employee. So 55 will become your fair value of the option. Is it okay? Yes.
Okay, sir.
This 55 is not 65 minus 10. It is just a coincidence. Okay. Don't think that it is, oh, it's 65 minus 10. No, it's just a coincidence. So this,
Otherwise, in earlier case, it is 25 only.
yes, 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 yes. Okay. So it's just a coincidence. So now, since you're repricing the share, your fair value is moving from 50 to 55. This incremental value has to be captured. Is it okay? Yes or no?
Okay, sir. That is the expenses, additional
Because
expense.
earlier you were supposed to get 75 rupees. Now you will get only 10 rupees. That means the fair value of your option is becoming more and more valuable. Yesterday, employees would pay 75. Today, they have to pay only 10 rupees. That means your worth of the option increases because it is virtually nothing compared to the market price of 65 rupees per share. Yes or no?
Okay, sir.
That is why you are having this incremental value of 5. This incremental value of 30, I will factor it from the period when it is made applicable, from the period the modification is effected. Correct? Yes.
Yes, sir.
So modification is effected in which period? Modification is effected in,
Yeah, year 2 and year 3 only because we are
yes,
only the prospective basis, not retrospective.
yes. So year 2 and year 3 into 1 by 2 into this should not be 2 by 2, 3 by 3. This should be 2 by 2. Is it okay? It is just a calculation, but otherwise it final will be the same. 3 by 3 bolo, 2 by 2 bolo, it is one and the same. Is it okay?
Yes, sir.
All right. So this one will go from the period you are modifying the options. So ultimately your expenses for year 1, year 2, year 3 will be cumulative. That means original option plus the repricing. Plus the repricing. Is it okay? Yes.
Yes, sir. Fine, sir.
All right. So that takes care of. Next, cancellation. What did I tell about cancellation? Cancellation is essentially when you remove the option from the employee. So when you take the option from the employee, you have to give them something in return, like a compensation. Plus, when you take something, the implication will be that the employee has already served. So whatever balance is there, you will accelerate and vest the entire expenses with the as part of the plan. Is it okay? Yes.
Yes,
That
sir.
is your presumption on cancellation. So here, for example, Anara Fertilizers issued 2000 share options to 10 directors for an exercise price of 100. The directors required to stay with the company for the next 3 years. Fair value of option 130. Expected number of directors are 8. During year 2, there was a crisis and the scheme was cancelled. Fair value at the time of cancellation 90. Market price at the time of cancellation was 99. There was a compensation paid to directors and only 9 directors were currently in employment. At the time of cancellation, it was agreed to pay an amount of 95 per option to each of the 9 directors. How the cancellation would be recorded. Okay. Now see. Year 1, you thought 8 directors will fulfill. Yes. So 8. Year 2, 9. Is it okay?
Yes, sir.
Currently in employment. Yes, at the time of cancellation, 9 directors. Okay. Fair value of options 130. This one. Next. Number of options 2000, 20 lakh 80, 23 lakh 40, 6 lakh 93, 16 lakh 46, 667. If everything was normal, this was what you would be doing. Are we okay with this?
Yes, sir.
Yes. Are we all okay with this? Yeah. So now when you are cancelling 9 directors into 2000 into agreed compensation rupees 95. You have written you will pay a compensation of 95. So 9 into 2000 into 95, 17 lakh 10,000 is what you are going to pay them as the compensation. But this compensation will not come entirely from P&L. Whatever is the balance in SBP reserve which you have accumulated on account of past vesting plus accelerated vesting, adjust that first and the balance only will go to the P&L. Because when you are booking the SBP reserve, already you are taking the hit to the P&L. Yes or no?
Yes, sir.
Yes. So therefore, whatever balance is in SBP reserve, meet that against the compensation. Over and above that, what you are paying, that only you take it to the P&L. So entry 1, 6 lakh 93 333 year 1, year 2, 16 lakh 46 667. So this brings the total to how much? 23 lakh 40,000. Now, when you are paying to bank account 17 lakh 10, SBP reserve 16 lakh 20, loss on cancellation 90,000. Are we able to follow this? Yes. Are we
Yes, sir.
able to follow?
Yes, sir.
9 into 2000 into fair value of option at the date of cancellation. That amount you will meet out of the SBP reserve. Because your compensation at fair value source is your SBP reserve. Anything over and above the fair value what you are giving is your choice. Please take it to the P&L. Is it okay? Yes.
Yes, sir.
And balance in SBP reserve, take it to retained earnings. Take it to retained earnings. No, nothing to prohibit you. But you can't keep SBP reserve as it is. It has to move to retained earnings. Because the whole point is what? The whole point is when there is no plan, I cannot have SBP reserve in place. If there is a plan, you can have SBP reserve. Is it okay? Yes.
Yes, sir.
So that solves this. Okay. All right. Cash settled SBPs, we have seen SARS, initial measurement followed by remeasurement. Okay. Cash settled SBPs we have seen, and SBPTs with cash alternatives also we have seen today. Right. So these were the 2-3 questions that we had done already. Okay. All right. SBPTs among group entities, something which is a novel item which was not there earlier. Parent issues ESOPs of subsidiary to its employees, or subsidiary issues ESOPs of holding company to its employees. How to do the accounting? Employee renders service to holding company, but it is getting subsidiary shares. For example, Tata Sons employees get shares of Tata Motors. Tata Motors is a subsidiary of Tata Sons. Tata Motors is listed, so its shares will go to the employees, but the company is going to get the shares will go to employees, but Tata Sons is getting the services from the employees. So what will be the entry? Can Tata Motors pass the entry employee benefit expense to SBP reserve? Yes. Follow.
Sir, it's a intercompany transaction, right?
Intercompany, yes. But the point is this. Tata Sons, Tata Motors employees provide services. Shares go from Tata Motors to the employees. Tell me, Tata Sons will debit employee expenses, correct? Because it is receiving the services. Yes or no?
Yes, sir.
What is it going to credit? Can it credit SBP reserve? Answer is no, because SBP reserve is coming
No.
from Tata Motors. Yes?
Yes, sir. We will debit to that Tata Motors
That's what. So
shares.
the other side is Tata Motors to, it is going to give the shares to SBP reserve. What is Tata Motors going to debit? What is Tata Motors going to debit? What is Tata Motors going to debit? Come on.
Tata Motors, they will debit to Tata Sun.
As what? As what?
Shares.
How can, who will debit shares? Tata Motors.
No, no, Tata Sun.
How can Tata Sons credit shares? Because shares are going off Tata Motors, right?
See, from Tata Motors is going from Tata Sun's account.
Yes. Tata Motors will give its own shares, huh? Not Tata Sons shares. Okay. Think. This will be nothing but, it is as if Tata Motors is paying a liability of Tata Sons. So it will kind of resemble a return of capital, what we can call as dividends. Yes or no? Substance will be what? If the payment does not come back, I cannot debit Tata Sons. So it will be as if it is dividends or distributable profit. Yes. And the other side will be dividend income. Yes.
Okay, sir.
Obviously, no. It has to be dividend income. If there is no repayment that will happen, why will the subsidiary pay a liability of the parent? Yes. Employees are
Yes,
providing
anyway,
service to
they're
the parent. Why it will pay? Yes. It will pay only if
so
it is
anyway,
something like a dividend. Yes or no?
yes, sir.
Yes. All right. Other side, Reliance Industries, Geo Platforms. Employees provide service to Geo. Reliance gives its shares to employees. So Geo platform entry will be employee expenses debit. Reliance will be to SBP reserve. Reliance is holding, Geo is subsidiary. Why is a parent bearing the liability of the subsidiary? It is making more investment. It is akin to making more investment. So investment in Geo, debit to SBP reserve. Whereas here this will be to capital contribution from parent. Are you able to follow? Yes.
Yes, sir. Here the buyer of equity, which will contribute.
What happened, Swami? I lost you. You muted yourself.
Yes, sir. Here the equity contribution
Yes.
from the, yeah, from RAL.
Parent is giving its shares to employees of subsidiary. Correct. Correct. So why will a parent incur a liability of a subsidiary? Employee expenses of Geo, ideally Geo should pay, but Reliance is paying. So why Reliance will pay? It is kind of making a further investment in the subsidiary. So it will be regarded as investment in Geo platforms to SBP reserve, and Geo platforms will pass the entry employee expenses account debit to capital contribution from parent. Are we okay with this? Yes.
Yes, yes, sir. Yes, sir.
All right. So with that, I think we are done with whatever we had to revise. I hope it was helpful to you. Yes. If there is any issue, please let me know, Swami. Anything, any doubts you have?
No, sir. It's very much clear, sir.
Very much clear. Was it a helpful session?
Yes, sir. Definitely useful session, sir.
Fine, fine. So with that, I think we conclude today's session. Manish ji, from my side, session is over. All the best, Swami, for your exam.
So thank you
Yes,
so much, sir.
yes, yes, yes. All right. Okay. You can conclude the session, Manish ji. Hello. Okay, fine. Yeah, done, done, done. Thanks. Thank you.